Good morning, good afternoon, good evening, wherever you happen to be in this world. This is John West, back to you with Japanese business and economy. Yes, as I said, John West back to you with Japanese business and economy. And now we're going to start our fourth class together. In the first part of our fourth class, class 4A, we're going to be looking at Japan's bubble economy. Now, as we've discussed in the first three classes, Japan had this fantastic recovery, fantastic comeback after World War II. Japan's economic renaissance after World War II is a beautiful story. And we see it in this chart, which I've shown you before, from 1945 through to the 1970s. Japan was growing so quickly. Then in the 1970s and 80s, Japan was still growing pretty well, a bit more slowly. By 1990, Japan's GDP per capita, the productivity of the economy, reached about 80% of the level of the United States. And in 1968, Japan became the world's second biggest economy. Could this beautiful story go on forever? Could there be something that might stop Japan's beautiful story of non-stop economic growth? In fact, something did go wrong in Japan, and the thing that did go wrong was that Japan developed a bubble economy. This photo of a discotheque in Tokyo captures the spirit of Japan's bubble economy. Japan thought that it was on top of the world. Everything was going great. Markets were going up. GDP was going up, but it didn't last. And so through the 1980s, Japan developed a bubble economy, and the bubble burst, destabilizing the economy and starting what we call Japan's lost decades. So I'm mentioning the term bubble economy. What is an economic bubble? In short, an economic bubble occurs when you have a dramatic rise in prices of something and followed by a dramatic fall. In short, bubbles go pop, as the name implies. And you see this quite clearly in this graph here of commercial land prices in Japan. Prices went way up, then came way down. And in fact, bubbles, economic bubbles, typically occur in real estate and stock markets. So how does a bubble economy occur? Often what happens is that a policy of easy money by a central bank fosters rises in prices. We have that now in the coronavirus economy, where central banks have easy money policies. It's very easy and cheap to borrow money. And so people do that, and they invest in real estate, they invest in the stock market. So even today, we see the risk of this happening. So easy money fuels price rises. Sometimes what happens is that these price rises are followed by irrational exuberance. People get carried away. They think that things are going to be fantastic forever. Importantly, you can only be sure that a price rise was a bubble after it crashes. If a price rises dramatically and stays high forever, it isn't a bubble by definition. Now, here's a little video on bubble economies.
When the price of an asset rises faster than can be explained by economic fundamentals, it creates a bubble. Famous bubbles include tulip mania in Holland during the 17th century, when the prices of tulips reached unheard of levels, and the South Sea bubble in Britain a century later. Here, speculators, which included a vast array of citizens, including parliamentarians and the King's mistress, drove up the share price of the South Sea Trading Company with disastrous results. There have been many others since, including the dot-com bubble in internet company shares that burst in 2000, and the bubble in house prices, which, when it burst in 2007, helped to trigger the recent global economic downturn. Economists argue whether bubbles are caused by the irrational behavior of crowds, aided in part by savvy speculators, or are the result of misinformed consumers who assume the inflated prices are sensible. Whatever their cause, bubbles do not last forever and often end not with a pop, but with a crash.
So that's an interesting, simple little explanation about economic bubbles. And of course, the video takes us back to tulips in the Netherlands, South Sea Island companies in the UK. Now, one thing that video didn't mention was the effect of easy money. And very often, easy money is a key factor in fostering price rises. Now, as the video mentioned, in 2007, 2008, we had in the United States a real estate bubble. And that, of course, was behind what we now call the global economic crisis of that period. And so you can see here in this chart, this is US National Home Price Index. And of course, the bubble goes up, and then it crashes back down. That bubble popped. And of course, the bubble economy that we're most interested in ourselves is Japan's bubble of the 1980s, which came crashing down in the 1990s. Now, what's the problem of the bubble economy? Basically, the problem is that people lose lots of money when the bubble pops, and that has very bad effects on the economy. We're going to be looking at very shortly what we call a balance sheet recession that takes place when a bubble pops. Now, here is a chart of the Japan chart we saw before was housing prices. This is the stock exchange, the Nikkei 225 stock index. You see there clearly, once again, the bubble. Prices go up, pop goes down. So in Japan, we had a bubble economy in the late 1980s, stock and real estate markets. Also, there's a bubble for golf club memberships. Now, stock prices rose by about 130% from March 1986 through to December 1989, while land prices rose by 60% from March 1986 through to September 1991. So how did these prices go up so much in Japan? During the 1980s, Japan's exports in economy were very strong. Japan built up a big trade surplus vis-a-vis the US and other Western countries, partly because of protectionist policies like a manipulated exchange rate. And so in this little chart, if you look at the very first part of the chart, you'll see there's a little up movement, then down. And so that up movement, that high level of the trade balance and the current account surplus, that is Japan's trade surplus vis-a-vis the US and vis-a-vis other Western countries that in fact concerned very much these Western countries. And so the US and other Western economies felt under threat from Japan, one, because of Japan's newfound strength as an economic and political power, but secondly, because of Japan's big trade surplus. So in 1985, the G5 countries got together at the Plaza Hotel in New York and with Japan and pushed Japan to stop manipulating the exchange rate, to increase the value of the exchange rate. And so under pressure from the US, Germany, France and Italy, the Japanese agreed to stop manipulating the exchange rate and allow the exchange rate to increase in value. Now you'll see that in this chart. here in the chart, in the first inch or so, you'll see the yen exchange rate around the 240 level. Then from 1985 on, the yen exchange rate moves down in the figure, but that is in fact an upward movement in the exchange rate. And it goes down to around about 100 around the 1990 period. Now, the important thing is that as the yen exchange rate went up in value, as it moved down in that chart, this adversely affected the competitiveness of Japan's exports and the economy. Now, from the point of view of the G5 countries, this was a good thing. They wanted to see Japan export less and import more. They wanted to see Japan's trade surplus go down. But this, in fact, had an adverse effect on the Japanese economy, and the Japanese government was very worried about this adverse effect on the economy. So the Bank of Japan, Japan's central bank, responded with easy money policies. Today, we would call this quantitative easing. And so these easy money policies meant that people could borrow money quite easily for investing in real estate, for investing in the stock market. And so this fueled a bubble in the Japanese economy. There was also irrational exuberance. Japan had grown so strongly after the Second World War. Through the 1980s, seemed to be a very strong economic and political power. And so many people in Japan, when they saw these prices go up, prices for land, prices for the stock market, they believed that Japan was probably overtaking the United States. Many people believed, particularly in Japan, that Japan could become number one. In fact, the value of Tokyo's Imperial Palace, where the Japanese emperor lives, at one point, it was valued at being more valuable than the state of California. It seems crazy today, but people believed these things at that time. And so by the 1980s, Japan became a new global power. The US, like today, was seen as a declining power. And in the US, there were genuine fears about the rise of Japan, just as there are today fears about the rise of China. This irrational exuberance, the excessive confidence, was widespread in the Japanese corporate sector and banking sector. Banks were quite happy to lend money to Japanese companies to invest in all sorts of things. And so Japanese companies went on an international spending spree, buying up all sorts of things. Mitsubishi bought part of the Rockefeller Center in Manhattan. Sony bought Columbia Pictures. And Japanese banks, through this time, they were the biggest in the world, like Chinese banks are today. They seem to be taking over the world like Japanese manufacturers had done, companies like Toyota and so on. Now, with this economic bubble, with prices being so high in real estate and in the stock market, the Bank of Japan began to worry. They began to worry about the effect of a bubble on the Japanese economy. So in late 1989, the Bank of Japan increased just a little bit interest rates in the Japanese economy. And at this time, there was also a change in market sentiment. People began to believe that these bubbles could not last forever. And so the bubbles started bursting. And if we think back to the charts I showed you before for stock prices and land prices, from early 1990, these prices came crashing down. And what they did was it wiped out billions of yen in wealth, leaving the nation's banks, enterprises, and citizens with mountains of bad debt. You can see in this chart, it's quite interesting that the bubble bursts there where the red is, and you'll see that the black line and the pink line, which are industrial production and GDP, and then the dark blue line, real GDP, in the period after 1990, they're in a much lower territory than they were before. And this is the impact of the bubble bursting, the impact of the wiping out of billions of yen in wealth. So what happens is that when you have a bubble bursting like this, you enter what we call a balance sheet recession. What we mean by this is that someone's assets are now much less than they were before, and that person's liabilities are much greater than their assets. So debt exceeds assets for many companies, many banks, and many citizens. And when you're in a situation where your debt is much higher than your assets, you have to start what we call deleveraging. We have to save money to pay off our debt, save money to rebuild our assets, get our balance sheet back in shape where assets equals liabilities. And it's this deleveraging as we spend less to reduce our debt, spend less to increase our assets, that has the adverse effect on the economy. Now, as Japan's bubbles were bursting, the Japanese government was actually quite slow to react. Firstly, many in the government, for a while at least, thought that real estate and stock market prices might recover. They thought that this might be just a temporary setback. It wasn't. But in addition to that, the Japanese government went through what we call the 5 stages of grief. Firstly, denial. When it happened initially, people couldn't believe what was happening. They denied what was happening. They hoped that they would wake up tomorrow and that things would be okay again. The second stage of grief is anger. People get mad about what's happening. Then, third stage of grief, start bargaining. Is there any way that we can maybe get back to where we were? Depression and acceptance. Now, the main point of this is that Japan and the Japanese government took quite a while to come to terms with the reality that they had been in a bubble economy and that bubble burst, and that the bursting of the bubble changed Japan forever. Now, in such a situation, rather than delaying, rather than denying what's happening, the best thing to do is to react quickly. And in such a situation, you should save the financial system. Every economy needs a financial system to function. So we need to save the financial system. We need to save the good banks, but let the bad banks go bankrupt. So save and recapitalize the good banks. Save the good companies and let the bad companies go bankrupt. And so in this way, we can digest very quickly the bubble bursting, the effect of that on the economy. Save the good, let go of the bad. But as I said, Japan was very slow to react. Another reason why Japan was slow to react was the Iron Triangle. I've discussed before the Iron Triangle of business people, government bureaucrats and politicians who get together to organize economic policy. And of course, some of the banks, some of the companies that should have gone bankrupt resisted that. The managers inside the company pushed the government, pushed the banks to go soft, to go easy on them. And of course, by resisting rapid change, this had an adverse effect on the economy. This gave rise to what we call the problem of zombie companies, zombie banks. Zombies are companies and banks that are in fact really bankrupt, but they're allowed to survive by bank or government finance. And this is just delaying the pain, not facing up to reality. And it's also sending good money after bad. It all means that if a young entrepreneur goes to the bank with a good idea and wants to borrow money, maybe he can't, because all of the bank's money is being used to help bad banks and bad companies survive. So in Japan, it took over 10 years for the government to solve the problem of the bursting of the bubble. This is very different from the US in 2008. The US economy started growing again as from early 2010. And so the US made a mess of its global financial crisis, but it recovered pretty quickly. Now, the bubble economy really is a major, major event in the modern economic history of Japan. Japan before and after the bubble economy had two different economies, two different countries. In the period from 1945 through to 1990, Japan was a country, an economy on the way up, doing very excellent, doing very, very well. But when the bubble burst, that changed the country forever. And Japan, since the early 1990s, has been a totally different country that had suffered from, initially, the effect of the bursting of the bubble and the financial crisis that was caused by it. But most importantly, the bubble economy and the financial crisis was not the only thing hitting Japan. We've discussed it before. From 1995, Japan's working age population started declining. Now, what this means is that while Japan is trying to come to terms with, trying to get over the financial crisis caused by the bubble economy, it was hit by something else, being the effect of Japan's aging population, the decline in its working age population. So something else hits Japan. Another thing started hitting Japan, and this was competition from companies in Korea and Taiwan. Korea started developing a bit later than Japan, but followed on a pretty similar path. And in the case of Korea, we've had companies like Samsung in the electronic and white good area, and Kia and Hyundai in the motor vehicle area. These companies came onto the market, and so Japanese companies during this period of the 1990s started to feel competition from companies in its neighboring countries like Korea and Taiwan. Japan was also hit by at least three other things, which I'll discuss now. In 1995, Kobe, a very important city in Japan, was hit by a major earthquake. And you can see here a photo of a building that's been knocked over by the earthquake. And the earthquake itself was bad enough. It had a major effect on Kobe and a major effect on the Japanese economy. But what is perhaps more important is the Japanese government mismanaged this earthquake. It reacted very slowly in terms of helping the people and helping the economy in Kobe. This actually shook confidence in the Japanese government by the Japanese people. The Japanese people felt much less confident than they did previously in the competence of their government to manage crises like an earthquake. This was exacerbated also in the same year, 1995, when there was a domestic terrorist attack in the Tokyo metro. Japan, as anyone who's been there would know, that Japan is one of the safest countries in the world, perhaps the safest country in the world. And Tokyo, even though it's the world's biggest city, is perhaps one of the world's safest cities. However, in 1995, in the metro, people going to work were hit by this terrorist attack. And so again, the confidence in the Japanese government was hit by this too. The terrorist attack was bad in itself, but perhaps the major effect was the perception that the Japanese government was not up to the task of managing these things. And in a similar vein, we saw around this period of time a number of corruption scandals in the Japanese government. I mentioned before that the Iron Triangle, this Iron Triangle of bureaucrats, politicians, and business people getting together behind closed doors to organize economic policy, invariably leads to corruption. And there were a number of corruption scandals that came out, which again shook confidence in the Japanese government. The Japanese people trusted much less their government to manage the country. And so these are very important things that shook this country that only a few years earlier, in the 1980s, felt on top of the world. Japan was taking on the world, and Japan could have been number one, we thought, in the 1980s. By 1995, all of this was shaken at the very foundations. The last point I'd like to mention was that the protectionist model that we've discussed in earlier classes was no longer effective in managing the Japanese economy. We discussed how Japan protected its economy, protected its industry through the 50s, 60s, 70s, and so on, and that this was very helpful for enabling the manufacturing sector to become efficient and dynamic. On the other hand, it was not effective at all for the agricultural and services sector. But by the 1990s, it was quite clear to economists at the time that this whole policy of protectionism may have been useful in the past, but was no longer useful at all. Japan should have opened up the economy to competition to improve productivity. But again, the Japanese government was very slow to react. It was not on top of things. And so starting with the bubble economy, starting with the financial crisis in the early 1990s, the Japanese economy hit the wall. Japanese economy began what we call the lost decades. And you can see in this little chart I have here for you, there's the red line showing the beginning of the lost decades. And you'll notice that the line for GDP after the beginning of the lost decades is much lower than it was before. And in fact, since the early or mid-1990s through to today, the Japanese economy has been averaging economic growth of around only 1% a year. That's very, very low. And this is the situation that Japan finds itself in, and we're going to be analysing in much greater detail in our future classes. So that's a quick overview of Japan's bubble economy and the bursting of the bubble and the beginning of Japan's lost decades. I'd like to thank you once again for joining me for this class. Domo arigato, arigato gozaimasu. And so if you have any comments, questions, reactions to this lecture, I would obviously be very happy to hear from you. Just send me an email and I can respond straight away to you. And of course, when we get together for our student discussions in mid-January, that's another opportunity to discuss this. But let me insist, the bubble economy, the bursting of the bubble, the beginning of Japan's lost decades, this is the beginning of the new Japan. This is the beginning of the Japan that we're still in today in many respects, and we'll be analysing in detail in the remainder of our course.